say that because it's hard to save early and often and start a business. But both of them, and if you've been around a little while and you look around you and you're like, okay, who are the people that seem to be comfortable financially? You're going to find out that they either started a business or they saved early and often.
Do you want a wealthy retirement without worrying about money? Welcome to the Retire in Texas podcast, where you will discover how to enjoy your faith, your family, and your freedom in the state of Texas. And now, here's your host, financial advisor, author, and all-around good Texan, Darryl Lyons.
Hey, this is Darryl Lyons, CEO and co-founder of PAX Financial Group. You're listening to Retire in Texas. Where building wealth comes with clarity, purpose, and peace, and we're guided by 1 Timothy 6, 17 through 19. I just really want to help you grow your net worth without losing your grounding along the way. And if that's what you're after, then you're definitely at the right place. This information is general in nature only. It's not intended to provide specific investment, tax, or legal advice. Visit paxfinancialgroup.com for more information. I'm going to split this podcast into two segments. The first will feature 10 principles that guide me in my money decision making. And then the second iteration, or the next episode, will be another 10. So total of 20. And I've been thinking deeply about the principles that guide me in a lot of the business and financial decisions that I make. And I'm trying to curate them. And I feel like I've got a good 20 here that I really want to share with you, but I know I'm missing some. So I'll continue to think about this over the next several weeks. And if there's some I need to add, then I'll do another iteration of this. But really want to have you challenge me even, hey, I agree or disagree with that principle. And then challenge yourself. Is that a principle that I should start taking a little bit more seriously and integrating into my rhythm of money? Because we discount the heuristics and rules of thumb that influence our lives. There's a new commercial that keeps popping up. Maybe it's because of what I watch. It's a lot of the financial news networks. And the first thing that comes out of the speaker's mouth on this commercial is, hey, you only live once, eat the cookie. I don't know if you've heard this before, but to me, it's like they're just dripping on you. They're just dripping on you. And before you know it, I promise you, I've seen this 1,000 times. People will start saying that you only live once. You only live once. It's so crazy how we just pick up on these rules of thumbs and heuristics. And I guess we're so easily manipulated in adopting these that we abandon even core principles that have been timeless through the Word of God. A lot of what I'm going to share with you are not scriptural, but I do have elements of my faith that I'll weave throughout it. But so let's jump into this. And I don't have this ranked. So I could do a top 10 countdown, but I don't have them ranked. So the first one is an emergency fund should be no more than 3 to 6 times your monthly expenses. This gets confusing because a lot of people think it's 3 to 6 times your monthly income. There's a significant difference between the two, or at least there should be. You have taxes, you have retirement contributions, you have health insurance. So it's your monthly expenses. And why is that even exist? Why 3 to 6 months and why times your monthly expenses? Well, if you have an emergency like your car breaks down or your refrigerator goes out, those can usually be absorbed somehow. Even though the average American right now can't afford a $400 emergency, I know many people in the audience that I'm listening to can. But 3 to 6 months is important because if you become very sick, this is where you're going to need that emergency fund. In good planning, you're also going to have a disability policy, whether it's with your group or individually. It's really important that you have one because actually the probability of becoming disabled is higher than if you died. Now, of course, people who are retired, this doesn't necessarily apply to. But on disability coverage, if there's a 90-day elimination period and 90 days before they start kicking in and paying you, I've processed these before. Not only is it 90 days, but then there's like a little month lag. So it could be 3 to 6 months before you actually get paid from your disability insurance policy. And you need this bucket of money to weather that. So 3 to 6 months. If you are a single, like a single mom, then you're going to need closer to 6 months. I know that's challenging, but you don't have another paycheck to fall back on. So you're going to need to squirrel away about 6 months. If there's two earners, maybe 3 months is fine. So it does vary for families. And then when you're retired, it's not as critical because you should have structured life in such a way that you're not depending necessarily on your income. But having 3 to 6 months is still important because if you do have, God forbid, an Alzheimer's situation or some chronic care need, there are a lot of out-of-pocket medical expenses to be considered in those situations. So, but it's very particular for those that are retired. Okay, I better move faster because I've got 10. At this pace, it's going to take me about an hour to finish this. So let me move a little faster here. Number 2, we pay attention to what we pay for. Staying in the healthcare conversation, we're cash pay. I mentioned this in a previous podcast. My family and I were cash pay using the Christian sharing programs that work real well. And oftentimes we ask questions, how much is this service? We even had... we probably saved this system, I'm air quoting here, the system, $5,000 because in the midst of dealing with this medical issue at one point in time, we were advised to go to an emergency room. And then when we discussed it with the doctor that we're cash pay, we quickly shifted to a non-emergency room. It didn't really make a difference to us, but it was real quick to see how we will just in the medical system waste money. And a part of it is the system, and a part of it's the consumer not asking questions because we don't pay for our health care in a lot of cases, so we don't care. That's just how life works. In fact, we had a financial advice service that we were giving away for free, and it was work and research, and we spent a lot of time on it. We started charging for this service, and not because it needed to be a revenue source. That wasn't it. It was because we know people pay attention to what they pay for. And so if we're giving out financial advice for free, they don't pay attention to it. But if we give it to them in such a way that it's reasonable in its cost structure, people will pay attention to the details and frankly, very likely implement the recommended ideas. So the second principle is you pay attention to what you pay for. The third one is, and I'm kind of vacillating here because I don't have this scripture down because this one is a scriptural one, is giving reflects your heart. This is a tough one because if I were to look at your banking transactions, your debit card transactions or your credit card transactions or the checks you write, I would be able to tell what's really important to you. I know you might say, well, if you look at my time, that reflects it. I get the time. The time is also a kind of a litmus test of what's important to you, but your money is also, because the scripture says, and I think this is Matthew 6:24, you can love the one or hate the other. You can be devoted to one or despise the other, but man cannot serve both God and money. So there is this competition for your heart, and it's reflected in your money. And if you love the gospel and you love Jesus and you want to make disciples of all nations, I should see that reflected somewhere in your financial statements. Not judging you. It's just, I think it's just judging ourselves. I understand the circumstances. I get that. But your giving and your money, just your money in general, it reflects your heart. Okay. 4, the best way to be rich, and I use air quotes rich, we can unpack that later, is to start a business or save early and often, or I guess both, really. So the best way to accumulate wealth or to be rich, I'm using that facetiously, is to start a business or to save early. And then if you do both, it's even better. I think I first heard this from Susie Orman. I don't recall exactly. And I remember thinking, okay, my objective in life wasn't to be rich. It was just not to be poor. I just didn't want to be poor. I just knew the challenges of not having money and what it did to a family, and it was hard. And so I didn't want to be poor. So I listened to people like Susie Orman. She said, start a business or save early and often. I thought, well, why not do both? But it's kind of actually hard to do both. I work with a lot of business owners, and all of us, and I would put myself in that category, are saying, I need to catch up because, my early 5 or 10 years, I was putting everything back in the business. And so I need to catch up on my investing and kind of diversifying my net worth. So I say that because it's hard to save early and often and start a business, but both of them. And if you've been around a little while and you look around you and you're like, okay, who are the people that seem to be comfortable financially? You're going to find out that they either started a business or they saved early and often. And sometimes saving gets some fuel if you work for a company like Valero or HEB. I guess maybe not HEB, but some companies that help really put some fuel behind it by matching the 401k. That's big. Be sure to take advantage of that match. And then maybe like stock options, things like that, help put fuel behind it. But that compounding is very real. Okay. Number 5 principle. Automatic investing is ideal in today's distracted world. There's a book called Automatic Millionaire. I don't remember the author. It's somewhere I'm looking around on my bookshelf. I don't see it off the top. But yeah, you don't have to read it. It just tells you if you just set up things and automatically you become a millionaire. It's crazy. It's absolutely true. I've seen it over the years. I've seen people with like $65,000, $75,000 incomes just put it on autopilot. They're investing both their 401k and then outside maybe their Roth, and they become millionaires. Now, I know millionaire isn't as much as it used to be, but still people who have, tight income profiles, I've seen become millionaires just by saving over time. It is absolutely insane. I've seen it. 401ks do an incredible job because they take it out. You don't even see it. So that's nice. But automatic drafts work too. Just set it up to where it's all automatically coming. There's out of your bank account and transferred each month. Do that. It's crazy. You wake up in 5 or 10 years and you've accumulated a ton of money. I've seen it over and over and over and over again. You don't have to be smart. You just almost have to be ignorant to a certain degree. I just know I need to save. Where it goes is another question, but these automatic millionaires, they are outperforming in terms of net worth those people that are day trading, that are getting cute with their money. It's just about saving. And if you can do it through a 401k, it's awesome. If you do automatic drafts, it's even better, or both. There's also something in 401ks now. This was a regulatory change recently that has automatic escalations where the money automatically that you're putting in increases each year. So that's one way to build wealth in a very distracted world. Okay, number 6. Your home payment should be no more than 25% of your take-home pay. Your home payment should be no more than 25% of your take-home pay. This includes your mortgage payment, interest and principal, along with property taxes. I'm trying to think if I have anything else in there. Property taxes is the main one. So insurance, principal, property taxes, all that payment. Some people separate it out. They don't escrow, but that should be no more than 25% of your take-home pay. Every time I've seen that ratio get out of whack, people are struggling to do things in life, whether it's go on vacations or save for their kids' college. There's just not enough margin in life. So that has to be less than 25% of your take-home pay, that home payment. Okay. Number 7. Similar to what we talked about before, but ideally you're saving about 15% of your gross income. This, again, if you're pre-retirement. I'll talk to you post-retirement in just a second. But if you're pre-retirement, you're what we call the accumulation phase in our nerdy network of financial people. You should be saving about 15% of your gross income. It's a pretty decent rule of thumb. And now, obviously, if you're 55, it's different than if you're 20. But it's pretty darn close almost every time I've run numbers. I remember Financial Planning Association came out with this detailed article, and they come out all the time that it should be around 16.67. I was like, well, okay, that's fine. But Dave Ramsey has often said 15%. And because of my nature, I want to try to, assess if that's reasonable. And sure enough, the self-proclaimed hick from Tennessee is pretty darn right, despite all the academic nerds having to formulate this 16.67. Dave says 15%, and it's pretty darn close. So really, if you're in the accumulation phase, you need to be saving 15%, especially if you're younger, because the profile of Social Security will be materially different for those that are younger. Those that are in their 55 plus, I don't see any material changes to Social Security immediately, but those that are younger, you are going to need to save 15% of your gross income for retirement. Absolutely, 100%. Okay, number 8. Now, this is for those that are retired. Your withdrawal rate of your investments need to be about 4% of your total portfolio. So if you're taking money out, let's say you got your Social Security, I'm not counting that, But if you're taking money out of your investments, that needs to be about 4%. It's called a withdrawal rate of about 4%. Lots of different studies on this. It comes out, I don't know, maybe every 3 months I see a study on this. And I wouldn't attest to have read all the studies, but I've read more than a handful of them. And there's not a huge variability at this 4%. I saw some good stuff with American funds a while back that showed 5 or 6%. I saw one the other day that showed 3%. So I'm still leaning on the 4% rule, with understanding that if you model things out on your own personal financial outlook, we use the Money Guide Pro and Monte Carlo simulation. If you model things out and you push up to that 5%, I think there's opportunity to do that, depending on your strategy. Depending on your life expectancy and your needs, and do you want to leave an inheritance, all that other stuff. So you can absolutely go to your advisor and say, I know Darryl said 4%, but I want to do a little bit more. I think you can vary from that depending on your unique situation. But 4% is a good rule of thumb. Let's say if you make 6 to 8%, that means your money is still growing to a certain degree and keeping up with inflation. Okay, number 9. I love developing, this is for retirees too, developing this legacy bucket of money. So it's a bucket of money that you set aside in an account that you've identified that you want to leave to the next generation. This is the legacy bucket. So there's a book out that's real popular right now. You could die with zero, but maybe have that legacy bucket be the one thing that you leave to the next generation. So your strategy, your financial strategy would be, I'm going to spend everything but this legacy bucket. I love that legacy bucket when you're retired. Why? Because it gives you a little bit of an opportunity to add risk to your entire portfolio. Because this money is not designed for you to need immediately. This is designed for you to leave in 20 or 30 years if you're 65. And even if you're 75, there's still a 10-year time horizon on this, because the money, a lot of people think, your risk tolerance needs to go down because you're 65. No, it's all about the time horizon of this money. So the legacy bucket gives you this permission slip to be a little bit more aggressive. And you need that permission slip. It really is healthy for you in retirement, because a lot of your money may be boring. And I don't want you to get this false feeling of you're not being a good steward of your money. If you have a little bit of that risk in your life, you have a point of reference and say, okay, I am being a good steward. It's just understanding how everything works together. So love the legacy bucket, not only from a strategic perspective, but there's some behavioral finance considerations as well. Okay, landing the plane. Number 10, you need to save $150 per month per child as soon as they get a Social Security card. This is for college planning. So right when your kid gets a Social Security card, you should start saving $150 a month minimum. $150 a month, generally. Again, you got different geographies, handful of factors. College inflation factor is certainly different. But saving $150 a month will pay for, just generally, again, that's assuming some returns. You're assuming the rate of return on your money and college inflation rate will generally get an opportunity for you to pay for just state school, just tuition. Just state school and just tuition. That doesn't include room and board or private school. But I think that's a good floor for most families. Now, if you want to save more, cool. If you want to throw in some bonuses or some grandparents' money, I think setting up a 529 account, allowing you to throw in money along your journey of life, whenever you get a little extra, throw some money in there. I think that's smart. You want to do that, but $150 a month should be the minimum when you're saving for your kids' college, right when they get a Social Security card. All right, that's the top 10 principles. I'm glad to share it with you. Let me count down again. Not count down. Let me repeat them. Number 1, an emergency fund should be no more than 3 to 6 times your monthly expenses. Number 2, we pay attention to what we pay for. Number 3, your money reflects your heart. I said giving reflects your heart, both of them. Money and giving reflect your heart. Number 4, the best way to accumulate wealth is to start a business or save early and often. Number 5, automatic investing is ideal in today's distracted world. Number 6, your home payment should be no more than 25% of your take-home pay. Number 7, ideally, you're saving 15% of your gross income. Number 8, ideally, your withdrawal rate on your portfolio is 4%. Number 9, developing a legacy bucket gives you a permission to add risk. And number 10, save $150 per month when your child gets his or her Social Security card. Lots to unpack. Thanks for hanging with me, and thanks for listening to Retire in Texas. Stay grounded, live generously, and remember, you think different when you think long-term. Have a great day.